Yo, what's going on, guys? Bexio back, and today we are going to talk about the stock market and the collapse that is going on and everyone freaking out about, and why it is a great opportunity for a lot of people to get involved in the market. So we've seen a lot of decline on the market. I mean, Apple's down like over 11%. Microsoft's holding strong. They're down only a couple percent. The tech stocks are down. Nasdaq's down, Dow Jones, all the major indexes are down, and a lot of people are worried and scared about the market collapsing and everything going way further down than where it is right now. So we can look back to obviously the start of this in March. Literally last year was around the time when the market started declining heavy and setting circuit breakers off, making everyone panic, and it just kept going down and down and down. And in hindsight, looking back at that, buying on the way down and holding up through this whole way up was a great way to make a lot of money in the stock market. So it doesn't matter that the stock's correcting. The market did have a like 90 to 100% gains. There's a lot of portfolios out there that made 90% this year or past year, and that is insane. So what we're seeing most likely right now is a correction of that, and it's fueled by the bond yields and interest rates going up, you know, and the fear of inflation, the fear of the interest rates going up. So that's a big reason why we're seeing this go down, even though Jerome Powell has said no inflation and interest rates aren't changing. The market just doesn't believe him. So during a market like this, it is actually great time to get blue chip stocks. You know, the Apple, Microsoft, Amazon, Google, the big tech stocks that have seen a big sell-off. Now is the time to think about getting into them more and think about expanding either the amount you have into it or getting involved in general, because the sell-off has happened. They might go down further. They might go right back up soon. So the reason that you might want to get in now is they're on sale right now. You know, a lot of people talk about tech stocks. They're on sale because the sell-off hurt them. All of them are down, and money might have rotated into like recovery stocks. But the big blue chip companies that you just can't go wrong with, that have been around for decades, like Apple, like Amazon, Google, Microsoft, even Disney is more of a tech, but that Disney's like the best of both worlds. You get tech and recovery. So Disney's a great thing to get in right now, I'd say. But the tech stocks are on sale, and this is another time you might be able to look back in 6 months if Apple goes up 50% from here and say, you know, this time was actually a good time to buy because it was on sale. There was nothing fundamentally wrong with these companies. And that's why I stick to blue chip stocks while the market's falling and collapsing and people are scared. The blue chip stocks, the very healthy, very strong companies that you don't have to worry about. They're not speculative companies. They've proven themselves. They print money. They know what they're doing. And those are the companies you want to get in at this time. Also, while you're getting into these companies, if you decide now is the time to get in, plan for the worst or plan for a bear market. That's what I did earlier in March, last March, when this happened. Was I planned for a bear market. I planned on holding these stocks and getting in and putting money in and watching it burn for a year and a half. That's the average bear market. So, although I don't think we'll see a bear market, planning for it is a good way to avoid panicking if things get a little bit worse or you see a little jump up and then it falls back down. It's easier to be prepared for a bear market than it is to have to adjust to a bear market. So plan for like a year of not making any money on these stocks. And chances are we're not going to see a bear market, but if you plan for that, you can keep putting money in, consistently get money into the blue chip stocks, and not really have to worry about too much there. But as well as you should be planning for 3 to 5 years at least holding these stocks. You're not going to be, you know, 1 year in and out or 1 month in and out. You should be planning 3 to 5 years at least of holding, you know, these stocks. That's like not even long term. That's still relatively short term, but a minimum 3 to 5 years, I'd say, is the best way to have an outlook of it. And protect yourself from being able to lose money. You're probably going to make money having a longer outlook than you will having a shorter one. And a big thing people might want to keep in mind in the back of their head, a lot of people might have been doing paper trading, trying to see what it's like getting in the stock market with fake money. And the only downside to that is you don't have emotion when you do that. So emotion drives a lot of decisions in stocks and in any investment, because when you get scared or worried about losing money, you're more likely to pull out of that investment just because you're worried about losing the money you put in. So know why you got into a stock like Apple. Know why you got in Apple. Know that if there's nothing wrong with the company, that there's no reason that it should be worried, because even though they might go down for a month, that over the next 2 years, they're going to be going up. Keeping long-term outlooks and things of like your emotions in check, and knowing why you invested in something. Know why you put the money there and how long you got it and what your plan is for that money. If your plan is to make 10% and get out, and that's more like a trader's life. I don't think trading is that great of an option, especially right now. I would think investing and saying, for the next 3 years, this money's here and I'm going to consistently put in X amount of dollars a week or X amount of dollars a month into the stock market, into this stock and this index fund, and really make sure that you're consistent with a long-term outlook and know why you're getting into it, because knowing your why is going to help you know or hold on to stocks longer and not get scared, not panic sell, and not get worried, and see times like this as times to buy stocks, times to get stocks on sale. The blue chips are on sale, and they rarely are on sale. So it's good to get them on a discount when you can. And so obviously with this dip, and obviously being scary that maybe right now we're down at the bottom and it might dip for another month, dollar cost averaging is your best friend to protect yourself in a market like this. So say you wanted to get in Apple stock and you want to make sure you protect yourself against short-term losses. If you have $1,000, you don't want to put $1,000 in now and in a month have it only be worth $700, lose 30%. I don't think that would happen with Apple, but it could. We are in a crazy market. So if you want to protect yourself from that, the easiest way is dollar cost average in. So if you have that $1,000, let's say, instead of all putting it in at once and saying this isn't the bottom and we continue to drop for another month, you can put in, $200 a week that would be 8 weeks. So for the next 2 months, you could put in $200 a week into Apple, into an index fund, into any stock, and protect yourself from it going down. So that way, if you buy in up here and the stock goes here, you buy in, you buy your average down, and when it starts going up, where you bought in originally isn't where your break even is. Your average price in will be lower, so if it goes back up, you'll make money sooner. So if you're always worried about losing money and you always want to try and time the market and say you want to buy at the bottom, or you don't want to buy now because it's going to continue going down, that's the easiest mindset to lose money in, to literally never get involved in the stock market, never get involved in investing, because you're going to be scared to lose money in the short term. And if you buy in now thinking that you're never going to get invested, you're going to be always scared of losing money. But the way you can turn that around is by buying in and having the 3 to 5 year plan, the 3 to 5 year holding of the stock. And you can say, even though Apple's $120 now, I think that Apple's a great company and it could be worth $300 in a year and a half. So this is a deal. Apple at 120 is a great deal compared to 300 if that's where you think it's going, even 200. It's a great deal, and it's going to give you more time to get there. And if you say Apple's 120 and it's got to be 200 by the end of the month, or you're selling, that's very, very unlikely to happen, and you're going to end up losing money with a mindset like that, saying that you don't want to buy in because Apple's going to go down more. So that's not a good mindset to have. Honestly, that's how you risk not making a lot of money, because right now people are scared, and you can do the classic Warren Buffett quote of be fearful when people are greedy and greedy when people are fearful. So Many people are scared. The market is pricing in bad case scenarios, interest rates going up, bond yields have been already going up, so that's happening. That's not planned out, but and then inflation coming. So the market's planning these things in, and if we down the road, if they're right, then the market's going to be where it's going to be. But if it's wrong and we start seeing things get better, or interest rates aren't going up like Jerome Powell says, then or the bond yields start coming down, which it could be with more companies that buy in, bond yields will come down. That's how bonds work. It's weird how they work, but the more people that buy in, the lower the rates are going to be. So as soon as we start seeing bond yields tick down, we might see the stock market start going back up, because people are going to want to get the return on their money that bonds would pay 0.5% once they get down low enough, and it's just worth it to put your money in the stock market. And instead of getting a guaranteed 0.5%, get a risky 7%. And then the last thing to keep in mind in the stock market is that some of the best trading days come directly after the worst trading days. So right now we're seeing bad trading days, losses, 10% losses, 12% losses, these big double-digit dips in stocks. We're seeing those right now. So typically what happens is the best trading days come a week after some of the worst, or a few days or a few weeks after some of the worst trading days. So what you don't want to do is miss the best trading days, because there's so many charts and studies that'll show you missing just like the top 30 or top like 20 trading days in like a 20-year period costs you money. And it's just insane what it can do. I'll show one of the charts here if I can find it. But it is absolutely ridiculous what happens if you miss the best trading days over a long, long period of time. So even though the stock market might seem scary and a lot of people might be losing money, this is the time where you can buy in and you can get blue chip stocks on sale and you can make the most amount of money. So you can take the proper steps to protect yourself of dollar cost averaging in that protects you from short-term dips, and still get your money exposed to the stocks that will go, when they go back up in value, then you're going to make more money than sitting on the sideline and buying on the way up, because no one wants to buy on the way up. You want to just continue buying the whole way. That's the best way to do it, is just constantly buying, putting money in. Dollar cost averaging is your best friend to protect yourself, and staying consistent with the right mindset and trying to control your emotions with the long-term outlooks is the best way to get involved in the market, and the best or the most rewarding to somebody that uses these tactics, dollar cost averaging and long-term investing. They're the most rewarding ways to make money in the stock market. So just make sure you know why you're investing and what companies you're investing in and why you're doing that. The why is a huge part. So take advantage of the market, take advantage of the sales. Blue chip stocks are just on sale right now. They're great companies. And as always, guys, don't forget to smash that like button and subscribe button. We are on the road to 1,000 subscribers. I'll see you guys in my next video.